Okay, so welcome again. In this case, I have the honor of introducing you Jeff Gramm. Jeff Gramm manages the Bandera Partners, a value-oriented hedge fund. He taught value investing at Columbia Business School for 7 years, and his book, Dear Chairman, Boardroom Battles and the Rise of Shareholder Activism, was named one of the best books of 2016 by the Financial Times. It has been praised as a terrific read by Andrew Ross Sorkin in the New York Times, a revelation by the Financial Times, a grand story by the Wall Street Journal, and an engaging and informative book by the New Yorker. Warren Buffett included Dear Chairman in the Berkshire Hathaway annual meeting bookstore. Charles Schwab wrote about the book. It should be required reading for anyone who wants to participate in our great ownership system as an investor or manager. I have to add, and I'm no one, but I have to say that this book is awesome. This is a thing that I have to say by my side. This book is awesome. It's very, very interesting. It's the stories that he tells, that Jeff tells, the way he uses the stories to conduct what he wants to teach. It's really amazing, and I think that's the reason he's. This book is a marvel. Anyways, in this case, we are gonna learn from Jeff many things about investing. So, hi Jeff, how's it going? Everything okay there?
It's going good. It's going good. Thanks for having me.
Yeah, it's a pleasure for us. It's a pleasure for us. We had the opportunity of interviewing you a few months ago, and actually having you on in this event is awesome. So if you want, Jeff, you can go ahead with the presentation, and then we will get through the Q&A, okay?
Great. Yeah, thanks a lot. So, we're sitting here in 2020, and my book is now 4 years old. And, I think it's a relevant book. I still give, dozens of interviews and presentations about it. And I really tried to make the book, to fill it with kind of broad business lessons, and not, it's about shareholder activism, but I really tried to make it a business history book. But, what I wanted to do today is, I wanted to actually talk about my day job, which is not book writing. I manage a value investing hedge fund. And, with all of these presentations that I've done, I've never actually given one about investing. So this is going to be the first time that I'm going to just give a few investing lessons.
So we are honored. We are honored.
Yeah, I'm really looking forward to it. It seemed like, when I was reading about, what you guys are doing and this is an investment conference, and it just feels like the right thing to do. And so I'm looking forward to doing it. And I'm looking forward to answering any questions that you have, either about the book or about investing. I'm happy to talk about anything.
Thank you, Jeff.
So my firm does, fundamental value investing. We do our own research. We're not a quantitative investment firm. We, buy individual stocks, and we have a very, concentrated portfolio. We only hold about 10 to 15 positions. And, fundamental value investing, sometimes if you read the paper or you talk like to other investors, it seems like a dinosaur, like a thing of the past, but I think it's not. And I'm going to talk about what I think are a few of the keys to performing fundamental, research and investment. So I'm going to share some of my slides here. They're not really slides. I just wrote a few talking points. And here they are. All right. So this is actually, I've only ever given one PowerPoint presentation, and this is my first, online Zoom thing. So does this work? Does it look okay?
Yeah. Let me check it. Yeah, perfect.
Okay, perfect. Cool. Because I see little screens and they seem to be blocking, but they're not blocking, I guess.
No,
all right. So, so let's just begin with the basics. What is value investing? And it really is, you think about a stock price as a piece of a business, and you try to buy that with a margin of safety against the intrinsic value of that business. And you focus on the long term and try not to be overly influenced by the market fluctuations. Everyone knows that. It's just worth explaining how, what I view the kind of key principles of value are. A stock is a real piece of a real business, and you're trying to buy it with a margin of safety, based on the long-term value of that business. I'm scrolling down. This is slide number 2. And valuation should be simple. What I tell my students is, that when you value a company, that you should think about it as essentially like the gas station around the corner from your house that someone is offering you for sale. The purpose of your fundamental research is not necessarily to figure out, how are the earnings going to be this quarter? Are they going to beat expectations this year? Like, you're really at first performing research to understand the economics of the business, to understand what makes it tick. And I feel like, this is a thing that people often misunderstand when they value companies. They try to get very complicated with complicated models, like without taking that step back and, really taking the simple approach of understanding what the business is and understanding how they make money and why. So treat it like the corner grocery or the corner gas station that someone is offering you for sale. One thing that I think is important, especially for young investors, is, do not perform your investment research as a quest to confirm your thesis. I taught investing, I've taught investing, for 7 years, and I continue to do lots of guest talks at business schools. And the one thing that you see with young investors over and over again is that they will kind of go into a situation where they already have a pretty strong opinion that the stock is a buy or a sell. And they won't perform the research with an open mind. They'll, perform it trying to prove that their preconceived notion was right. And, the key to investing, one overarching fundamental key to value investing that we'll come back to over and over again, is that you really have to avoid bending reality, to fit your needs. Over and over again in life and in investing, people, bend the truth or bend reality, to kind of get the answer that they want to get. And so when I look at a stock, I always try to approach my research with as open a mind as I can. And I try not to have a preconceived notion, this is going to be cheap. This is going to not be cheap. I think it's also important when you do your research, especially as a young investor, to understand that the law of diminishing marginal returns applies to investment research. You can spend years looking at a stock. You can talk to every single customer. You can talk to every vendor. And in the cult of value investing, exhaustive fundamental research is very lauded. It's a thing that everyone talks about as important. And it is important to the extent that you do that to help you understand the business. But you can understand that business like with 80% of the work. And to get 80% there, it might not take that much time. It might take a few days. And that final 20% could take forever, and it might not even be worth time. And so, one key thing is at a certain point, extra research, can be counterproductive, and it can begin to get you wedded to the idea. Doing too much work on a stock, can actually begin to bend reality for you. And that's a thing that we'll go back to over and over again of, are you doing anything in your investment process or your portfolio management process that is going to make you less rational? And in some ways, doing too much, fundamental research can get you really committed to an idea when it's not healthy to be committed to it to that extent. This is a big one for me because, when I began my career, I was very proud of my ability to find my own ideas. I was very proud of being kind of outside the pack, of being a little bit of an outsider in the hedge fund business, not necessarily fitting in. And so, finding what I saw as like unique ideas that other people didn't have. And I think for years that led me to be biased against very good ideas that came from other people. And when I talk to young investors today, I noticed that mindset is pretty common. Like, you want to find your own idea, like you want your own home runs. But I think, it's hard to find good investment ideas. Like, the market is pretty smart, and you can't just be allergic to other people's ideas. Like, you need to be open to looking at something that maybe, Bill Ackman owns and has given a 100-page presentation on. That should not disqualify it from coming across your desk. And at the same time, like with that lesson of, don't be allergic to other people's ideas, you need to be very careful not to cut corners, like assuming that other smart shareholders didn't. So once you go down the path and you have a few successful investments that you got from other people's portfolios or that other people told you about, you need to be very careful about the situation where you look at this stock, my friend Steve likes it and he's really, really good. And I can't just assume that I can kind of cut some corners like, oh, this one risk is a little bit complicated. I can't really wrap my head around it. But Steve's really smart. I bet he figured it out and he owns it. So he's comfortable. So I should be comfortable. Like, you need to be careful of that mindset. Some of my worst investments were definitely in ideas that I got from other people that had a risk that I very much knew about and that I kind of took for granted, or not took for granted, that I kind of ignored because I just assumed, well, if they own it, they must have thought about this and they must be comfortable with it. Concentration is a double-edged sword. So concentration, like when I say that, I mean the size of your position in your fund. So how large your investments are, So my fund is very concentrated. We have 2 positions right now that are each 20% of our portfolio. So we own 2 companies that combine for 40% of our investment capital. And there's a lot of talk, and Joel Greenblatt talks about a lot in his first book about the value of concentration. When you get a fat pitch, you swing for it. Charlie Munger talks about this. He has said things like an investor should be comfortable putting 100% of their net worth into a single investment idea. And I think that you need to remember that, while concentration can drive investment returns, supersized positions totally cloud your judgment. And in our battle to avoid bending reality, I think that nothing is more dangerous than a very large position in your portfolio. If you have too much at stake in any one position, if it's too hard to admit defeat and to sell, if it's too hard to say, oh, I got 20%, I'm pretty sure this is going to double, but I'm also nervous. I mean, if you don't really want to sell because of the profit potential of that huge position, there just are so many ways that supersized positions can cloud your judgment. And again, the whole game of fundamental value investing is really keeping your judgment clear. And so concentration is very dangerous and can really play tricks on your mind. Insider transactions. Almost every stock pitch that you see, if it's a buy pitch or a sell pitch, we'll talk about insider transactions. They'll talk about if the board or the management are buying or selling shares. Bullish theses will often talk about how the CEO has been buying shares, and short theses will talk about how the CEO has been selling. And there are some situations when you see aggressive buying by sophisticated insiders that it can be a signal, but it's just a signal. And I think one thing that I've learned over 20 years of doing this is that you can really ignore almost all insider transactions. Company insiders are rarely sophisticated investors. They're just as capable as your average Joe of making dumb investment decisions with their money. And so people put way too much weight in insider transactions. Financial metrics. I have a few in a row here about financial metrics. And one key thing which I stress, because my students are always asking about what numbers to use, what metrics are the most important. And before we even discuss that topic, which we will discuss later, you should know that financial metrics alone, such as a company's return on capital, they can't confirm the existence or durability of a competitive advantage. So we use like all these metrics to kind of figure out if we have a good business, their profit margins, their growth, and probably the most important one is return on capital. How good of return does this business generate on the capital that you deploy into the business. And when that's a high number, that is an indication that you might have a good business here with some kind of competitive moat. But the number in and of itself is not proof. And I see over and over again pitches where they'll say, this is a really good business. It's a really good business because it has high returns on capital. And the thing that you learn over time is that return on capital number can just disappear. That competitive advantage can disappear. The moat can be filled. And if you're just relying on a number and not your own judgment and your own research to really understand the business, then you're hurting yourself. It's important to always know that perceived competitive advantages can very quickly dissipate, and being overly reliant on a financial metric like return on capital is quite dangerous. There are no magic formulas in fundamental value investing. One of my favorite investing authors is Joel Greenblatt. He was my first investing teacher, and I feel like I'm in this business because of him. So with all due respect to Joel Greenblatt, I really think for the kind of investing that I do, you really can't look at numbers in a vacuum. Like you really have to be, wary of any kind of like foolproof, formulas or metrics. When I teach, I always get asked about like, what is the one key number to use when I'm valuing a company? And it really depends on the company. If you're looking at some businesses, it could be some kind of a metric involving, gross margin. Like, we own a heating oil company. And I would say for that business, the most important number for evaluating how they're doing is their gross profit per gallon of heating oil that they sell. So for every business, there are particular metrics that are important for helping you understand that business. But there's no, universal foolproof magic formulas as far as I've learned. Process-driven idea generation is rare. One thing also that I hear a lot from aspiring investors and from my students is they want to know about how you find your ideas. What's your process for finding investment ideas to look at? And this is also it's a thing that a lot of institutional investors who invest in hedge funds are focused on. Like, do you have a repeatable process for finding ideas? I'm very dubious that these exist, and I've seen them, investors that have armies of screens or that use complicated idea sourcing through analyzing Google searches in particular markets, all kinds of things like that. And I'm ultimately of the opinion of there's not that many, public companies out there. If you're looking at public companies, efforts to kind of, refine a process like for generating the ideas aren't necessarily going to be as valuable as, really refining what I call the 5-minute filter of, when a stock comes across your desk, can you kind of look at it, read a few pages from the 10K, look at the holders list, kind of figure out like, is this something where there's like, potential for the market to misunderstand it? Can I wrap my head around it? Am I able to perform research on it? It's like that 5-minute filter that tells you, is this a stock that I feel like I can get there on? That's to me way more important than what screen you use. And ultimately you can just look at all stocks that begin with the letter A. And I think that might be more valuable if you have a good 5-minute filter than, like whatever kind of effective screen like you might have worked up. There are many ways to make money in the market. I think this is a really important one, especially for value investors who tend to be pretty close-minded about how to properly invest. In investing, you need to kind of develop your investment style so it fits with your temperament and your skills, but you can't assume that, the way that you invest is better than how other people invest. There are a lot of ways to make money in the market. I love value investing because it fits with how I think and how I work. And I think I have a good temperament for it. But under no circumstances do I believe that, value investing, the way that I do it, is a better way to deploy capital than a quantitative strategy, like a high frequency strategy, a momentum strategy. Ultimately, there are so many ways to make money in the market, and you need to respect that. And you can't close your mind to other ways to beat the market. And I think, to the extent that you do, that you're really closing your mind to, to money-making opportunities. It's always worth, trying to understand how other investors succeed in the markets. And if you dismiss another guy's, oh, that's like just a momentum strategy, then you're hurting yourself. Like they might know something that you don't. And like the more that I've done this, like the less that I am, rigid about what works and what doesn't work. It's like, it's hard to succeed as a fundamental investor. And, one thing that I'll talk about a lot in the rest of my presentation is about like avoiding hard rules that basically box you out from making money. Oh, here we go. Be wary of hard rules. As I've talked about, rationality, not bending reality is key in investing. And, and I also believe that flexibility is key too. And you shouldn't develop habits that limit your flexibility. That you'll hear people with all of their, I don't do this, I don't do that. I don't buy leveraged companies. I don't buy, special situations. I don't do litigations. I don't do short-term trades. I don't buy other people's ideas, blah, blah, blah. Like all that stuff. But like investing is hard, and hard rules that limit your universe are problematic. I think they're doing laundry, vacuuming upstairs. Sorry about that. I'm working at home because of the pandemic. A value investing portfolio theory. Portfolio management theory is interesting because, it's another thing where it's kind of built around hard rules. Like you'll see people, they'll have a stop loss. If I lose 30% on a position, I sell. I don't buy over, 10% of the portfolio in one name. I won't begin a position at, more than 5%. Like all these like are kind of portfolio hard rules. And I think it's important when you think about your portfolio to understand that often, portfolio decisions, like they're not necessarily, based on objectively producing the best like returns for a given, strategy. Like they really are, like they boil down to, do they fit with your particular temperament and skills in your quest to stay rational? And so all of these things like, how you leg into positions, how you size your positions, how you trade, if you hold a level of cash or if you, remain fully invested, there's no right or wrong answers there. If you develop hard rules here, it should be because they temper personal stylistic issues, because it should be because they help you stay rational. So for example, I like to kind of run with very little cash. To me, when I get into holding a big chunk of cash in the portfolio, it becomes another lever for kind of how I'm feeling about the markets, which I don't necessarily want to have that lever. For lots of people, A, they do want to have that lever and they might be good at using it. And B, they always want that dry powder, which, can be very, very, very valuable. And like, to me, like I've learned the utility of the immediately available dry powder isn't as much worth it to me as like the risk of if I'm holding, 20% of the portfolio in cash, that it will kind of begin to affect my judgment. So like a lot of these like portfolio decisions, you should really view them as to how they blend with your own personal style. And they're less about, finding some kind of objective maximization of profit. So we're getting into a little bit more of the philosophical investing points. And this is like another one that I feel very, strongly about. I feel like in the investing world, there's a little bit of a bias towards, making it seem like an intellectual pursuit. And there's this, this thought of like, when you look at a stock, you have to outwit the market and you have to be, better than the guy on the other side of the trade. And, I think that's just kind of a completely dangerous and misleading mindset. And for young investors, I really try to stress that the intellectual conceit of being, the smarter person in any given trade, I think is dangerous. Like I think that ultimately when you find good ideas, that you often know there's a sophisticated and smart investor on the other side of the trade, and you often know why they're trading, and they might have a rational reason for them, like to be getting rid of the stock. And this idea of like, oh, the people on the other side of the trade are just a bunch of dummies, I think you need to be real careful of. There are fewer dummies out there than you think. And if you kind of, treat the market as like, oh, I'm the smartest guy in the room, I think that you're, beginning to set yourself up for some damage. This is another one that I feel pretty strongly about, and that, I have a lot of very smart friends who disagree with, with me on this, but I'm not a subscriber to the theory that investing is a liberal art. Like I'm not even that much of a subscriber to the whole, Charlie Munger lattice work toolbox as it relates to value investing. I think it's incredibly valuable for so many things, including business management. But in terms of, fundamental value investing, being one-dimensional and having a lot of focus is more valuable than you think. And, the kind of expansive intellectual grounding that comes with a liberal education, they might be helpful for living a fulfilled and happy life, but I think they're really overrated for providing investment edge. People talk about, Charlie Munger as the ideal investor, but he was really a professional, fund manager for a decade before he flamed out. Warren Buffett is, way less, well-rounded than Charlie Munger is. He's a lot more one-dimensional. He's not gonna, talk about like complex, like adaptive systems and ant farms and stuff. And he's the better investor. So, I think that it's helpful to kind of to get away from the intellectual conceit that you see with a lot of investing. I don't think it's a liberal art. I don't think that you need to have an understanding of concepts from all kinds of disciplines to succeed. And I don't think you need to be the brightest guy in the room. Like, you really need to do your work, to understand businesses, like to understand why the person on the other side of the trade is there. But you don't need to understand that, like, I'm better than they are. Management teams are excellent at telling you what you want to hear. This is a hard one. And, in my years as a fund manager, I've really gone back and forth on how important it is to kind of have a dialogue with management. It's true that as a fund manager, you are a fiduciary. Like, you have investors who are giving you their money to manage, and you in turn are essentially giving that money to public company management teams. And so you do have a fiduciary duty, to do some work to kind of understand that management team. And I think I always do try to meet with them. And, you want to kind of understand how they think. And, lots of times in these investments, there's no easy mechanism to get rid of them. So you are kind of, wed to management as long as you're invested in the stock. And I think that you do owe it to your investors, to learn about, a management. But all that said, the actual utility of having a good relationship with management and knowing them, I believe, is highly overrated. And the longer I've done this, the less important I think it is. And I think that ultimately it's just not really that valuable. Like for me, when I talk to a management team, I'm trying to kind of to pick their brain to learn about the business, if I'm trying to kind of understand the business better. But then once I'm kind of there as a shareholder, I want to make sure that they're not idiots. But I don't think a regular dialogue with them is all that valuable. So I just want to point out, if you have a really good call with the CEO and they say all the right things, don't forget that they're very good at saying all the right things. They know what you want to hear. They're very good politicians. They're saying completely different things to their directors, to the board. So just be very wary, and when you do your own work, don't be overly influenced by what you're hearing from the CEO. I think lots of experienced investors will tell you the same thing, that early in their career, they for sure had some investments where it felt like they were just on the same wavelength as the CEO. They were saying all the right things. This was for sure going to work, and then it didn't. And I just think over time that you learn that there's less value in a good relationship, with management than you think. Volatility equals risk. I mean, the mantra of risk is not of investment risk is different from volatility, and that you can just always be there to endure the volatility if you have a long-term view. You just always have to keep in mind that that volatility is risk. Even if you have your own permanent capital, volatility, if it's greater, is going to play with your emotions and is going to push your ability to stay rational. And then if you do what I do, if you're a fund manager, then there's clear direct risk from volatility, because you could get redemptions when your stocks are down, or if you put up a very bad month because of the volatility, it can be career risking. So you know, there's a lot of these kind of value mantras, and I love a lot of them. Like I think, you know, thinking about a stock as a piece of a business, you know, buying with a margin of safety. Those are very good, you know, value investing mantras. I don't subscribe to volatility does not equal risk. It does. It's a very much a kind of risk. The enduring value of long-termism. And this is a really big one. And I think this is why, you know, true fundamental value investors can still outperform the market, even in this era where, you know, if you have enough money there, you can get credit card data, you know, telling you exactly how every retail company is doing, you know, to the day. You know, you can pretty much map out how a quarter looks with, you know, with technology and data now. But if you have the courage to take a long-term view, to take a step back and to really look at the long-term value of a company, you know, then you can really generate alpha that way. And just looking at the success of so many businesses will prove that. And you know, one obvious example is if you think about Google, Alphabet, it's got like 60 sell-side analysts on it who publish estimates on what they're going to earn this year. If you look at 3 years, there's only like 5 or 6, you know, who, you know, will really have the courage to publish like what they think they're going to earn in 3 years. You know, very few people like really look at long-term earnings power. And, you know, that's what drives long-term value. And, you know, as tough a time as, you know, value investors have had, there still is a tremendous amount of return that can be generated if you can take a long-term view and figure out, you know, better than the market can what like a business is going to make in the 3 to 5 year period. So, you know, like to me, you know, being able to look a few years out, you know, rather than a few quarters is really a kind of key principle of value investing, and very few people do it. And, you know, like there's a lot of talk of value versus growth, you know, and we buy lots of growth companies because like that 3 to 5 year view, you know, people often get wrong with growing businesses. So we're coming down to the end. This is my last lesson. And I think this is a very important one. I talked earlier about how at the beginning of my career that I didn't really want to invest in other people's ideas. And I think it's the same thing with, you know, with trying to cultivate, you know, valuable relationships in the industry. You should cultivate some peers and learn from them. There are fewer, you know, lone wolves out there in the investment world than you think. Even guys like Warren Buffett, you know, people talk about how Buffett is out in like on an island in Omaha, but if you look at his correspondences, he corresponded with a ton of other investors, and he had this whole network of people in the 50s who were doing what he was doing. Guys like, you know, Charlie Munger and Rick Guerin and Walter Schloss. And I think it's important that, you know, like you really learn from your peers in this business. It's not just that they can give you, you know, great ideas, which they can, which itself is a reason to cultivate some peers. But you can really learn from them about how to be a better investor. So that is it for me. And thank you for tolerating my investing thoughts.
Well, it was awesome. Yeah. No, actually, it was. I mean, I wanted to tell you that it's super interesting, this presentation, since you are explaining the way to invest and your point of view about investing. So it's really cool because it's not just presenting your product or what you do, but just teaching investing. And this is really, really interesting because our concern is to teach. I mean, we want people to learn, and we do our best to get these interviews with you guys. We do as much as we can to bring the teachings to the investors. And actually, this is what you have done. This is a master class, Jeff. So I'm super exciting. Thank you, man.
Thanks. Well, I mean, I think it's important, and you know, like I think the great thing about like what you're doing is like, you know, like you have guys like Tobias or Wes, I mean, or Meb, and you know, I like invest completely, you know, differently from those guys, but you can't, you know, even if a person is not investing the way that you invest, there's a lot that you can learn from them.
Well, this is exactly what you
they have.
Exactly. This is the idea of learning from the peers that you cultivate. So it's totally clear, and I like a lot this last idea actually. But I have a question also that is,
sure.
I want to see if I captured properly your meaning, because you said something that is awesome. You said volatility equals risk. Even the mantra is volatility doesn't equal risk, you know? So, because this is a way for vendors very likely to say, okay, this is I mean, it has volatility, but no problem. You can stick with the strategy, or you can stick in the fund. So my question is, how do you stomach the journey in this situation? I mean, you say that you can, or you should endure value of long-termism, and okay, but value brings, I'm a value guy also, so I understand this perfectly, but the idea is value brings also pain. So how do you stomach the journey?
Yeah. And I think that is like the key thing, you know, like we hear all these, you know, rules from Buffett, all of like the tips from, you know, people on how to invest and how to value companies. But I mean, all that stuff in some ways is easy, you know, like the concepts of investing are easy. What is really hard is actually keeping your cool and your rationality through the whole process. That's the thing that, you know, will really, if you can keep a cool head, is the most important thing. And it's kind of like you have to learn how to do it. I think it's a little bit dispositional, like too. You know, like I think that Buffett is probably just a cool cucumber naturally. And I think, yeah, like we all rationally know that if you can endure over the long term, that the volatility of the stock, you know, shouldn't matter, because like you're there for the long term. So if it goes up and down, like that, like should not increase your, you know, fundamental risk if you have permanent capital. But we're totally neglecting the two key points of like, well, one, if you don't have permanent capital, then your investors will clearly get very nervous when your stocks are down. And then two, even if you do have permanent capital, it's a constant, you know, battle to stay rational. And, you know, more volatility affects that, and it hurts you in that battle. And like, I mean, I'll give you like an example, like, you know, our second biggest position is a company called The Joint. It's a chiropractic firm. So they have these clinics, and, you know, during the pandemic, so in March, that stock went from like, you know, $17 to below $8. And it went there in like 2 weeks. And, you know, there like was definitely cause for concern about how is this pandemic going to affect this business? You know, like what is the business going to look like post-pandemic and through, I mean, and at that point, like, you know, even the pandemic itself had kind of irreducible uncertainty of like what it was going to look like. And so it was an unbelievable task to try to kind of figure out the range of outcomes with that one company. And the idea of doing that while the stock has just gone from 18 to 7, and to stay rational and to try to do it is just like very, very, very difficult. And so when we say things like, well, volatility does not equal risk, it completely neglects like the real difficulties of investing, which are, you know, keeping your capital and keeping your cool. And I think there are tons of investing lessons where it's almost a premise that like you're going to stay rational for it, like when really half the battle is the staying rational.
Yeah, it makes all the sense. I mean, this is, I think this is very likely the most difficult thing to do as an investor, to try to keep rational in this situation. And how do you deal with this pandemic now regarding your investments? I mean, now we have this situation, the post-COVID era very likely is going to change many things, and so we see this situation, the debt skyrocketing all over the world. So how do you see the post-COVID era, and do you think this is going to affect your investments, or you think that it's something that it'll be just in the short run, and then if you keep in the long-term ideas, you will pass through it?
I mean, it's a very hard one, and obviously there's like this issue of this, well, also reveals how destructive a pandemic can be. I mean, like, you look at just the economic damage from this thing when the fatality rate is exceptionally low. I think if someone had told you, like, there's going to be this thing, here are the stats on it, they would have not predicted the kind of economic carnage. And it really drives home, if that fatality rate were actually 2 to 3%, or if just the kind of, like, if it were like a little bit more contagious, just kind of how crazy the carnage would be is very eye-opening. But for us, like, I would say in March, we very much were looking at things with, like, holy cow, there's a crazy range of outcomes here. Like, all these people, there are people like, who are saying, oh, this is like the buying opportunity of a lifetime. And there were people who, like, were, sprinting to the hills with a bag of cash, and we're like, I'm not going to, like, invest any capital. And I don't think either of those guys were right. Like, I think it looks like the ones that bought at the lows were right, but I mean, I think at that time there was just a lot of uncertainty. But well, since then we've had 4 or 5 months to kind of, we'll see how the world is adjusting, and like, a lot of economic activity is resuming. So for my little chiropractic chain, I mean, like, they had some sites that closed in March in one state, in Colorado. And so we have a lot of data on, how the customers are doing. And, like, the customers have largely kept coming. And I think what you are seeing is that ultimately, I don't think this pandemic is going to end overnight, but I think that ultimately consumers' risk tolerance for catching the disease is, will largely going to be higher. So I'm not really investing in, any kind of, like, lasting, changes. And, like, there will be changes. There will be changes to kind of the events business and business travel and remote, working. But I'm not banking on any huge big changes in behavior out of this. And I largely, I'm focusing on the businesses where, our two biggest positions, like our biggest one is a heating company. People are still going to heat their homes. Our second biggest one is, people, go into a 1,000 square foot crowded clinic to get a chiropractic adjustment. And I was nervous about that, but now I'm seeing that the customers are largely coming back. It's a young customer base. They're, millennials and Gen X, and that there's a huge demand, like, among, with franchisees for opening new sites. So, like, I'm not really, super concerned about the immediate behavioral effects of the pandemic.
Understand.
The economic effects will longer term, like, a worry.
They will come, but anyways, it's true that you are invested in the company per se, not exactly. Mm-hmm. I mean, you are not a macro guy, so in that case, your focus is in this concentrated portfolio, and this is super interesting. If you can, if you understand the companies that you own, I think this is a fantastic approach. And of course, I hope the attendees are learning a lot, because it's a way to be able to stick with the strategy. The more you understand the business you own, the better for you to navigate these circumstances, even if they have to change a lot, you know. So Jeff, has been really a pleasure. This is, I mean, I'm super glad of having you in this event.
Yeah,
And,
thanks for having me. It's been fun.
It's a pleasure for all of us. And I just wanted to tell you that I'm super excited, and the roundtable that is also around the event is going to be super fun also. And I will run. I mean, I'm going to direct this roundtable where you are. So I'm super happy of having you there also. So Jeff, thank you, and I hope we keep in touch and see how things are going.
All right. Thanks a lot.
Okay, Jeff. Thanks. Bye bye.
Thanks.